7th of September 2025. And what's going on in Bitcoin and crypto? Well, if you've been following the markets since earlier today, I told you specifically look out for what the VEPs are going to do because they're setting up for some probable moves. We're seeing it happen. Now the question is it fake out? Is it a real rally? Is this a bear trap and a bull trap? Or have bears already been trapped thinking it was going to go lower than it did before it starts running up higher intraday or even on the week? Well, we're now in the last day of the week, and we still have a good number of hours before the end of the week for crypto assets. And it could very well be that this is just a temporary pump and then dump, and then we'll see it make the next maneuver when the next week starts. It also could be a significant bull trap where it gets people excited by pumping up significantly and then having sales pressure hit hard once it reaches certain levels, right? Look at the VRE levels, look at the Laplace distribution levels, look at the normal distribution levels on the hourly, and on the daily, and the 4-hour, and the VRE levels on the monthly, weekly, and daily. Look at those levels. Notice where each asset that you're looking at is moving through those levels. Notice how it's hitting certain specific levels and then you're going the other way temporarily, right? Because those levels are take profit areas, especially the VRE levels, but also the Laplace and normal distribution levels. They're all take profit areas, yeah. But the answer is it a real rally or is it a bull trap? Or is it the other way around? Is this actually a bear trap because it's just going to, the rally is just going to keep pumping and all the bears that are, now in the negative from earlier today, are they feeling the pain now? How long is that going to go on? But you'll notice even during the day, on the lower time frames, 15 minute and under, even higher than that, I mean, frankly, even 90 minute, 45 minute, 30 minute, whatever, you'll see the asset distribute away from the mean of returns, and the asset mean reverts to the mean of returns. And by the asset, I mean the returns of the asset, yeah, because that's what we're looking at. We're looking at the returns of the asset. The price is irrelevant. As I've explained to you millions of times, the price just mainly follows the returns. That's pretty much what it does, reliably. That's what price does. It follows the returns. Sometimes it's out of line with the returns, but like we're talking like a candle or two. 3 is like an extraordinary rare thing. Usually it's in line with what the returns are indicating. So, right now, sure, it's going well for bulls, for people longing at the asset to the upside, obviously. Whatever asset it is that you're going, I mean, of course there are assets also moving down at the moment, right? And I'm sure right now, right this second, if I were to look at the charts, there's a probability the asset is literally coming down right now. I don't know that because I'm not in front of a chart right now. But I know that when I looked at it minutes ago, there was a little bit of movement down. Once the assets hit certain levels of the VRE and the Laplace and the normal distribution, and each asset obviously has its own levels to hit, and they pretty much all did, at least the ones I looked at. The ones that were pumping nicely over the past couple hours, several hours, and now they started to, mean revert a little bit. And the price action was following to the downside. Does that mean? Whoa. Does that mean that the assets will automatically just continue moving to the upside the whole time? Or is there a possibility it could go sideways or even dip back down significantly today, even before the market resets, and then, And then gap watchers are going to be waiting for the asset to close the gap if it finishes above last week, last Friday's gap. Or, they're going to, if it goes under the gap and closes the week there won't be a gap to fill, technically speaking. There's no gap. Then what is it going to do? Is it going to dump out? That's no way to trade. Waiting for a narrative to tell you what happened doesn't tell you anything about what is likely to happen. Okay? If you can know what is probably going to happen on this candle and or the next one, you already have a qualitative advantage and a quantitative advantage, more importantly. Well, just as importantly, because they're both important, over the 99% of the retail market that has no idea that this type of trading even exists. Like they genuinely do not know that quantitative trading is a thing, let alone how it works. And what we do at Alpha Trading is, in fact, quantitative trading, using quantitative tools, essentially, that we built, but made available to the retail market. Pretty cool, right? It is cool. That's something that we did. And yeah, I mean, what can we say? They're the best calculators on the market for this kind of thing, in our opinion, available to retail traders. We've even developed tools that, as far as we know, don't exist for anyone, anywhere. Like, not in the highfalutin world of high frequency trading firms, not in the world of quantitative traders. It just doesn't exist, right? Why? Well, it doesn't exist because we came up with tools that nobody ever thought of before. And that's why those things don't exist. Maybe they will at some point by other people, but for now, we are the ones who make that set of tools that include some things that simply do not exist for other traders. And you'll have a lot of fintech companies and whatever. They'll each have their own differentiators. Right? That's one of ours. We have tools that very much differentiate our tool set from other people's tool set. Being able to predict the future direction of the RMLR is a very strategic advantage when it comes to trading. It is something that gives the trader a calculable edge. Like, numerically, you can actually know the value of your edge and the probabilities of it being correct. And if you manage your risk properly and consistently, and don't let ego stand in the way, and don't think, oh no, I can't lose $1 here. So it's better to lose $1 than to lose $100 or 1,000 or 1,000,000. Right? As long as you're winning the vast, overwhelming majority of your trades, then if you lose the occasional dollar here or there, which is basically like your entry fee, your ticket price, then you don't have to worry about those occasional minor losses. It's more important. Like, if you win 4 out of 5 trades, or 4.5 out of 5 trades, 9 out of 10 trades, you're doing fine. As long as you keep those losses tight. Try not to go over 1% loss in any given trade. Seriously. I know it's hard, especially when you're using leverage and you think, oh, it's going to bounce right back up. It's just at 1.2%, no big deal. And then it gets at 2%, and you're like, it's just 2%. All I have to do is go back up, a couple percent with leverage, no problem, it'll go back up. Well, what if it doesn't? Then you might end up with a bigger loss, or you might wait a very long time in a position that's holding you back from using that capital to make more money, until eventually it comes back to break even, and then you'll just be happy to get a break even trade. And then you've just wasted all that time on that trade. And it could be hours, days, weeks, or longer, depending on your appetite for pain. And does that really work to you? Which is why I always say, take your profits early and often, limit your loss, and don't be emotionally attached to your trades. Right? If you follow those 3 rules and you operate under risk management, tight risk management, so that you don't allow yourself to lose, a significant number on your trades. You should be wrong not more than 1% on your trades. You should be out if you're at 1%. If it jumps to over more than 1%, just get out. Just get out as quickly as you can. Even if it's 1.5%, 2%, whatever. If it's like shooting down or shooting up against your trade, just get out. Don't try to be egotistical and think, oh, it'll go back closer to my entry. Well, what if it doesn't? Especially if it makes a crazy move. Yeah, it might reverse immediately, and you might be back in profit very quickly. But what if it doesn't? Do you really want to eat 3% loss, 4% loss? Then now you got to make a few more trades to get that back. Why? You could just cut it at 1% and get it all back on the next trade, and then some. And then the trade after that, you're already back in the profit. Right? So the loss of opportunity is much greater than the loss of the dollar. The loss of opportunity to take the correct trade on the next move that you make is much greater than the loss of the dollar for pulling out if it gets to, say $1 is your 1% if you're trading with a tiny account of like $100 or whatever. Right? Just as an example. Imagine if you're trading $1 million or 10 million or 100 million or $1 billion. Then what does that 1% feel like? Right? Sure, money is perspective, perception, and all that. But do you really want to be sitting on a 1% loss of $1 billion account or $100 million account? No, you don't. So get out of it before it reaches that level. That's good there for now, folks. Happy trading. Peace.